Have you ever walked into a grocery store to buy ingredients for a healthy, balanced meal? You don't just fill your entire cart with red chilies, or load it up completely with sugar. If you do that, your meal will be a disaster. To stay healthy, you need a smart mix of proteins, carbohydrates, healthy fats, and vitamins. Well, building a stock portfolio works exactly in the same way. Hello friends. Today we will discuss 14 types of stocks, the building blocks of a balanced portfolio. If you spend 10 minutes today, it will help you in your entire investing journey. Many beginner investors jump into the share market and buy whatever stock is trending on social media. The secret to long-term wealth creation isn't finding one single, magical, stock. It's understanding that different types of stocks serve entirely different purposes. Before we map out the complete universe of stock categories, please note this video is strictly for educational and investor awareness purposes only. I am not a SEBI registered research analyst. Consult a certified financial advisor before making any investment decisions. Let us first look at classifications based on ownership and governance structures. This tells you exactly what kind of rights you hold as a part owner of the stocks. Common stocks. These are the standard shares most retail investors buy on the stock exchange. They offer the potential for long-term capital appreciation and dividend growth, and voting rights. However, there is a catch you must know. If a company completely fails, shuts down, and has to sell off its assets to pay its bills, you, as a common shareholder, sit at the very end of the line. The company will use its cash to pay off bank loans, suppliers, employees, and preferred shareholders first. You will only get paid if there is any money left over at the absolute end. Preferred stocks. These are special shares. Companies often issue these shares to large institutional investors in their early stages when they need massive capital for expansion. Think of them as a cross between a stock and a bond. They pay a fixed, predictable dividend income, and if the company ever closes down, preferred shareholders get paid back before common investors. The trade-off is that they usually do not give you voting rights, and their prices do not grow as fast as regular stocks, making them a choice for investors who want stable income instead of aggressive growth. Next, let's break down with the most common ways the market organizes them. Market capitalization. Market capitalization, or market cap, is simply the total market value of a company's outstanding shares. It tells you how big the corporate empire is. SEBI classifies the Indian stock market into three main categories based on size: large, mid and small cap stocks. Large cap stocks. These are the top 100 largest companies listed on the stock exchanges by market size. These companies are well-established market leaders with solid balance sheets and highly stable business models. Mid-cap stocks. These are companies ranked from 101 to 250 in terms of market capitalization. These represent mid-sized businesses that have outgrown their volatile early stages but still have significant room to expand. They offer faster growth potential than large caps, but they carry a higher level of risk and price volatility when the market gets bumpy. Small cap stocks. These are all the listed companies ranked from 251 onwards in market value. These are smaller, early-stage enterprises or specialist players with aggressive expansion possibilities. While they can deliver exponential growth if the business scales successfully, they also carry the highest failure rates and extreme price drops during market corrections. Now that we have sorted stocks by size and ownership, let's look at how they react to the actual state of the economy. This is where we look at cyclical versus defensive behaviors, and growth versus value investment styles. Let's look at economic cycles first. How does a company react when GDP is booming versus when a recession hits? Cyclical stocks. These are companies whose business performance is directly tied to the health of the broader economy. When the economy is booming, sectors like automobiles, real estate, metals, and luxury travel etc. experience massive demand. However, during a recession, consumers cut back on these non-essential items, impacting the profits and stock of these companies negatively. Defensive stocks. These are companies that sell essential goods and services that people must buy regardless of the economic situation. Sectors like pharmaceuticals, fast-moving consumer goods, FMCG, and utilities, like electricity and water, fall into this basket. Because people still need medicine, soap, and electricity during a recession, these stocks provide stability and act as a shield for portfolio during bear markets. Next, we look at the internal financial philosophy of the company. This is the classic growth versus value divide. Growth stocks. These are companies that are expanding their revenues and profits at a much faster rate than the industry average. These companies rarely pay dividends. Instead, they deploy their earnings straight back into building new factories or developing new technology. They command premium valuations because investors expect massive future capital appreciation, but they carry a heavy risk of sharp corrections if their aggressive growth targets are missed. Dividend yield stocks. These are mature, highly profitable companies that regularly distribute a portion of their earnings back to shareholders as cash dividends. These stocks belong to stable, slow-growing industries where the management doesn't need to hoard cash for massive expansion. They provide investors with a highly predictable, passive income stream, making them incredibly popular among conservative or retired investors looking for cash flow. To completely round out your stock market directory, we must look at how stocks behave on the trading terminal, and explore a few highly specialized categories that professional investors track. First, let's look at how a stock's price moves relative to the broader market index, which is measured by a metric called beta. High beta stocks. These are shares whose prices fluctuate much more intensely than the broader market index like the Nifty or Sensex. If a stock has a beta of 1.5, it means that if the market rises by 10%, this stock is likely to shoot up by 15%, but if the market drops by 10%, this stock could crash by 15%. Always keep in mind that beta is based on historical averages, not a future guarantee. It only measures market-wide risks, so if a company-specific event happens, like a factory fire or sudden management changes, a stock can still crash even if its high beta says it should be rising with the market. Low beta stocks. These are shares whose price movements are much more stable and muted compared to the volatile swings of the broader index. A stock with a beta of 0.5 will only move up or down by around 5% when the market swings by 10%. They provide price stability. Now, let's explore three specialized categories that you will frequently hear about in financial news networks. Blue chip stocks. These are shares of massive, globally recognized companies with an unshakable reputation for quality, reliability, and financial resilience over decades. Think of these as the absolute royalty of the stock market. They have survived multiple economic recessions, carry minimal debt, and have dominant brand moats, making them the ultimate long-term compounding machines for any safe portfolio. Penny stocks. These are highly speculative shares that trade at extremely low prices, often below 10 or 20 rupees, and have very small market caps. While the cheap price tags look attractive to beginners who hope the stock will double overnight, penny stocks are incredibly dangerous. They often suffer from poor corporate governance, severe lack of liquidity, and can easily be manipulated by operators, leading to permanent capital loss for investors. ESG stocks, environmental, social, and governance. These are companies evaluated and selected based on their commitment to ethical operations, environmental sustainability, and strong governance standards. Large institutional funds and global investors are increasingly pouring capital exclusively into businesses that prioritize clean energy, fair labor practices, and transparent management. Investing in these ensures your portfolio is aligned with modern global regulatory shifts and long-term sustainability trends. Hope now you have the complete map of the stock universe. When you want to analyze, you can verify a company's market cap, beta value, dividend yield, etc. from free using authentic sources NSE and BSE websites. Additionally, for quick screening and comparing these metrics side by side across, these parameters are easily accessible on online financial screeners. This video is strictly for educational and informational purposes only. I am not a SEBI registered investment advisor or research analyst. The metrics, data, and financial concepts discussed here do not constitute financial advice, investment tips, or buy, sell recommendations. Investing in the securities market is subject to market risks. Please read all related documents carefully and consult a certified financial advisor before making any investment decisions. If this complete guide to stock categories helped clear your confusion, hit the like button, share it with your friends and subscribe to my channel for more such informative content. See you in the next video.